On this week's episode, I'm excited to bring on Patrick Grimes as a guest. Patrick has over 14 years of experience in active real estate investing, purchasing distressed assets, renovating, and stabilizing for long-term cash flow. His $416 million portfolio includes 3,385 units in multifamily apartment communities in the emerging markets across Texas and the southeastern United States. Patrick currently co-sponsors syndications with strengths in underwriting, conducting due diligence, authoring pitch decks, and raising equity with $20 million invested from his network of passive investors. Patrick is also the co-author of Amazon's #1 best-selling book, Persistence, Pivots, and Game Changers. He's also on the Forbes Real Estate Council, where he authors thought leadership articles and contributes to expert panels for Forbes on investing and commercial real estate. Introducing the CEO and founder of Invest on Main Street, Patrick Grimes. Welcome to the show, everyone. On today's episode, I'm excited to have Patrick Grimes join us. He's the CEO and founder of Invest on Main Street, which is a real estate private equity firm. Patrick, welcome to the show.
Hey, glad to be here. This is going to be a lot of fun, I can already tell.
Hey, I'm super excited. You know, real estate was one of my first businesses and I still love it. It has a huge place in my heart. So I know how excited you must be to talk about real estate. But before we get into that, I would love to learn a little bit more about you. Tell us your background, how you even got introduced to the asset class, and what you do now.
Yeah, so I snot-nosed engineer back in mechanical designer, starting out back in 2000s, early 2000s. Worked for a machine design firm and was doing well. One of the owners there gave me some advice, said you should not invest in high tech, everything if you're working in that space. It's fun, it's cognitively rewarding, but you're also going to see that it's volatile and it probably won't set you up for the future that you want. Invest as much as you can, as soon as you can into real estate. So I dumped everything I had into what investments I thought were going to double and triple my money, and I wrote it all down hard in 2009, 10, and 11. So that was the beginning.
Okay, so someone told you not to invest in the stock market, put it instead in real estate, and you still ended up hurting yourself financially in the crisis of 2008?
Took me years to recover from that one. Yeah. I was investing in more speculative stuff. You know, I was doing pre-development and buying land and hoping to build on it. I was hoping that I would get it to the point where we could build, and I was hoping we could build, and I was hoping to have something that would cash flow on the other side of all that. And unfortunately, during that bridge is when the market fell out. And so they had me personally guaranteed on loans, and they came after me. It took me a number of years to recover. But when I dove back into high tech, I'm a huge nerd inside, so it was very natural for me. And I got a master's in engineering and business and started doing well again. I realized I needed to diversify again. And I got back into real estate and learned about recession resilient markets and cash flowing assets that perform well during recessions and the right type of strategies to buy and hold. And so I started doing that, and then eventually traded up to larger multifamily apartments in growth markets and syndicated, and that's where Invest on Main Street came about.
Wow. Okay, so that's incredible. So you lost. I mean, this happens to every good investor, right? You have to go through those dips because otherwise you're not even a real investor, right? So you went through that pretty early on, you recovered, and now you're in the multifamily space. So what was that tipping point? When did you realize you're doing something wrong, or what could you have done better during that time to possibly prevent such a major drawdown for audience who are looking to get started?
Well, so I was not humbled. Right. And as you said, it's good to have those moments in which you lose everything, because those moments then make you wiser and smarter moving forward. And I was looking for things that would double and triple my money on a regular, every year or two. And that was short-sighted. I wasn't thinking about risk-adjusted returns, and I wasn't penciling in what's the worst case scenario. And it turns out the worst case scenario is not what people are saying. Like in 2006 and 7, people were saying, oh, the market's never going to go down. It's going to stay solid. Go ahead, keep rolling the stack on green 24 and spinning the wheel. The house never wins. And so That was, I mean, that was basically the advice at the time. You can't go wrong in real estate. Well, it turns out in any kind of investment, you can go wrong, and has to be the right kind of strategy. And so I tell people now, don't be the hare, be the tortoise, and invest in only in deals that can ride out recessions and in markets that and in assets that actually perform very well. And so all those lessons were great. And the diversification out of the stock market was still the right strategy. And we currently diversify into energy, oil and gas drilling, which is also an essential need like housing. And those are still the right strategy. You just got to do it in the right way. And to your point, with the right partners that have been humbled and have failed and come out of it and learned how to be patient.
Right. That's how you know you have someone on your team that knows what they're doing because they've felt the pain before, right?
Mm-hmm.
So you mentioned something that caught my interest. You mentioned recession resistant properties. What are recession resistant?
Well, so it's not the case that every real estate asset plummeted during the 2008 and 9 recession. It just so happens to be that there are places in which things were fairly stable. Houston's a great example. In fact, it was one of the strongest markets through the 9, 10, 11 downturn. And that steady state growth of Houston that grew leveled off for a little while before it started going up again just a few years later. Whereas most markets and the country overall took a dramatic swing down where some markets lost 20 to 60, sometimes 80% vacancies in places like Las Vegas and Phoenix, and it's wild. And then it took 10, 12 years to even break even. So I did analysis and figured out, what were these markets and why were these markets, and I paid attention to economics and listened and did a bunch of. Turns out that you can buy in markets where there's recession resilient employers. Like energy was in Houston. Education. In fact, Houston currently has the largest life science center destination in the world. I mean, it's a hugely recession resilient. Finance and accounting, logistics, all these things that are not like the vacation, retail, hospitality, boom bust type things. And high tech tends to be also a bit of a boom bust because it's very transitory. So those kinds of things that those kind of infrastructures in place as pillars of a market you can find in numerous locations in the southeastern states that we invest in. And you can see that either they did take a small hit, but they recovered quickly, or they didn't take as strong of a hit. And you can track those and still invest in those kinds of markets today.
So for those who are listening right now in 2023, do you see any of these markets that are potential opportunities for investments? Of course, not advice, just purely out of your opinion.
Yeah. So, I mean, I was just sending out data for Fred, like the Federal Reserve data online. You can download it yourself. And actually, Austin's right now like taking a plummet, and it had been a huge boom market, right? Phoenix, same thing, taking a plummet. But those were the leading markets in the country, right? Those were the ones that had some of the most dramatic increases in the country. And so you're already starting to see some major corrections happening. So you can see in some of those markets that took dramatic increases where all the hype and excitement is are now starting to correct. And other markets like Houston, Dallas, Atlanta, some cities in northern and southern Carolinas, for example, we're in Jacksonville, North Carolina, and North Augusta is like Augusta, Georgia. Those are very strong markets. They have very recession resilient employment makeup. And as long as you're in one of those markets, you're kind of in the primary hub and you're finding the right kind of asset. Because again, it comes down to what you're buying at the end of the day. You should be fine.
Got it. So let's say you identify a property. How does interest rates play a role in whether it's a good deal or not, especially with the rising interest rate environment like we're in right now?
Well, we're doing a deal right now that is a 10-year fixed Fannie loan, which means agency debt and 10 years fixed interest, 5.3%. Now that may feel like a high interest rate, but back in 1982, interest rates were double digits and people were still making money in real estate. So as long as you structure the deals appropriately, and it's not just the interest rate, you need to get long-term debt or you need to buy rate caps. Right? You buy that property in a stabilized market so you won't see a huge dip. But then you have to do low enough leverage. So if you reach a rate cap, you can still pay your bills. Leverage means get a small debt a small amount of debt or put a high down payment down so that you cash flow heavy. And I really look not just at interest rates or occupancy, I look at break even occupancies, because the break even occupancy is going to say, hey, look, how much vacancy can you have before you can't pay your bills anymore? And that's perhaps the most critical thing, because you got to say, well, worst case scenario, what if my interest rate grows to my rate cap? And then what is my break even occupancy at that point? Because my debt service is going to cause the bills to be constrained. And if you can find something that has like a 20-30% break even occupancy in a case that the worst happens and your interest rate has gone to its cap and you can still ride it out, then you're in like a workforce housing type existing construction project that cash flows on day one. You're in a good position to ride out a recession.
Got it. So you're basically saying if the numbers make sense, go for it.
I'm an engineer and an analyst at heart, and so I do look at the numbers. And it isn't the case that everybody looks at numbers the same. In fact, that's going back to what we said earlier. If you've been through a downturn, then you know how the models can break down. You know how the demand can shift. But if you haven't, you don't even understand the question that I'm asking oftentimes, and you wouldn't know to put in the proper protections within the business plan in order to. And I mean, some of the things we're doing to protect are replacement cost insurance and loss of rent insurance. So if we're at a situation when we're in an economic downturn and we get hit by a natural disaster, we can recover, but we have to front the money for that. So in the case that there's a financial or natural disaster, we have to have reserves. So we'll raise an additional 6 months worth in reserves and just put it in an account and sit there. That lowers our investors' return up on a projected side because we have capital on the sidelines, but it preserves your capital in the case that you have a bad day, you don't have a bunch of money, and you're riding out a recession and a disaster happens. By the way, all these scenarios are happening right now. Interest rate caps are consuming all their income. They're upside down because they bought in a boom bust market, and a natural disaster happens, or a COVID happened where they had a bunch of people not paying rents. And those are the deals that we're picking up right now for discounts. So we're just structuring our deals, and have been, in a way such that we don't become the distressed operator that we buy from today, because we see them all the time.
That's really interesting. The best time to raise money is when you don't need it. And people are happily giving you money when you don't even need it. But the moment you need money, it's very difficult to raise it, right? So I think that's extremely smart that you're taking a bunch of cash, keeping it on the sidelines. So if a black swan event happens or something happens, you have enough cushion to survive and probably even thrive, like what you said with what's happening with, I guess, people not paying rent, and you're able to pick up all these great deals at discounts. And that brings me to my next question. How are you finding deals? Again, for the audience who are interested in potentially getting into commercial real estate, how do you even source deals? What's step number one?
Well, so I started out traveling around, meeting with brokers, walking properties, and it's a long, difficult slog because most of the properties that are on the market are fought after by 20 or 30 buyers that are more liquid than you, have a stronger reputation, and they perhaps bought and sold with that broker numerous times. So the broker just wants to keep their business, and that puts food on their table. And you're a huge risk, because if you fail, then that broker is going to get fired because he just wasted many, many months of that owner's life, because they need to be closers. So the broker needs to find a closer. So it's very challenging to break into. There's no question about that. In fact, pretty much all of the deals that we're working on are deals that don't go to the market, that we hear about from pocket listings, from brokers, from lenders, all kinds of different sources, where people are struggling and distressed, like the one in Atlanta we have. The guy, 14% of people not paying, and then a building burned down. And so the guy was like, what am I going to do? And he didn't have the reserves. The interest rate payment had squeezed his cash flow, and so we sold it at a $5.25 million discount to us. We closed very quickly, and we raised the capital after. And we closed quickly to get the lowest insurance rate, locked it in for a long time. And we have more patient investors that are willing to take a reasonable return for a longer term, more capital preserved hold. But that kind of thing was just a broker pocket listing, and you need to move fast. And there's story after story after story like that. So typically what I tell people, you can certainly go meet brokers. My typically I tell is partner up. What I did on the single family side is try and do it all by myself for many, many years. And it was tough. I was doing high machine design, automation, and robotics by day, and then moonlighting my real estate portfolio at night. And I was buying out of state. I live in Southern California, Orange County here. And I was buying in places like Texas. And I don't even know how I did it back then because I was doing it all remote at nighttime. But then when I met my wife, I was like, or my soon to be wife, I was like, I have to stop this because I can't moonlight my real estate career marrying my wife. So I tell people, look, partner up, partner with people that are in the markets that you want to invest in. That's not in California. It's a terrible market out here. People that have experience, take less of the deal, but figure out how to bring in value. Figure out what they need. Maybe they need underwriting. Maybe they need somebody to help do the due diligence and the grunt work and the dirty work, right? Maybe they need to find investors and need to find capital, or maybe they need somebody to constantly asset manage because they need more time with their family, friends, and hobbies, and they're too busy to constantly be looking after all the investments. Figure out how to bring them value, and then learn from them, and then you can piggyback with their relationship as you become a partner over time. And that's the best way to break into the market.
I think that's a really solid piece of advice. The best way is to get basically a mentor, even if you're not necessarily a 50-50 partner, work underneath someone and have them kind of show you the ropes so you can one day do it on your own. And during that story you're telling, something you mentioned actually, I thought was really interesting. You said you closed on the deal, which you got at a $5 million discount, and then you raised the capital afterward. Could you talk about that? How is that possible? And just teach us about how that works.
Well, it's somewhat consecutively, but especially today, you don't have the luxury of waiting because of interest rates. Even if you can negotiate with the seller, hey, give us 60, 90 days, you don't want to spend 60 90 days because the interest rates are just picking up, right? And so, but even before then, I can tell you deal after deal after deal where we have partners that are family offices or high net worth individuals that have come in and helped us just put up their own capital for a partnership percentage to help us close. And then we syndicate or backfill it in parallel and or entirely after we get the closing done. Because the deals we need are the deals we want to prevent from going on the market. And if the sellers had a bunch of time and they weren't distressed and they went to market, then they would be selling it for probably a $5 million premium, not a $5 million discount, right? Yeah. So we come in and we provide the ability to let them move on, right? And we do it right away. And with the closing reputation, my partners and I have been able to be very successful at that, and our investors win. Now, sometimes it's also because the deals happen at the same time. We'll be right in the middle of the capital raise on one deal, and maybe we'll find a couple deals a year, maybe 4 deals a year, and maybe 2 of them are at the same time. So we need to just time because we can't raise 2 deals, or we don't choose not to raise on 2 deals at once, that kind of thing. So, but yeah, the ability to bring the capital is a strong benefit.
Well, thank you so much for sharing that. And you said you have relationships with family offices and other high net worth individuals. Could you briefly talk about how you built those relationships for people who are interested in raising capital themselves?
Yeah, it's the same story. I just networked.
You just networked.
Simple. Because I spent 2.5 years when I stopped doing single family, and I told my wife, no, I'm not doing it anymore. And she said, well, what are you doing then? And I was like, well, I'm still doing automation at that time, and I've now left that in purely real estate and oil and gas right now, which we should probably touch on a little bit. But we traveled constantly all over the United States and met a bunch of people, looked at a bunch of deals, probably went through between 6 and 10 different potential partners before we actually settled on the first group that we did a couple deals with, and was a big win. Now, I kept networking and meeting, and some of those ones that saw that I was a real player and I was in the space and I was actually producing different, then they were attracted, like, let's work on a deal together too. And so I just met a bunch of people through that. And if you keep showing up, there's a big dropout rate in the space. Yeah. But as soon as you do your first deal and you keep showing up to the plate, they're attracted to that. Now, at the same time, we have similar relationships on the energy side because, I lost everything in real estate. Real estate is not perfect. I was alive during 8, 9, and 10 when I wasn't everybody else. I think that the stock market's going like this, right? But real estate can do that too, right? And it's certainly not going to be that strong, but we've been on the biggest tear for many, many decades right now. in real estate. So there is a correction happening. In all of our decks, we say we're ready to ride that out. But I actually think the strategy to a healthy portfolio, and if you look at my own passive investor guide on investonmainstreet.com, it says diversification is the way to do that. And essential needs, housing, food, and energy, and I'm focusing on housing and energy. And energy allows you to, there's no debt there. You're asking about interest rate risk. There's no plan to get any debt in that. So obviously interest rates, real estate has nothing to do with it because it's natural gas and oil drilling. Those are two different commodities. So this sentiment-driven stock market, these are called non-correlated assets from each other. And it's important to be able to hang your hat in a completely non-correlated asset. May not be lower risk than real estate. In fact, there's very few things that are lower risk than my 20 to 50-year-old multifamily workforce housing deals, because those cash flow like animals, and they're going to, but sometimes cash flow goes down. Interest rates go up, cash flow goes down, and valuations correct. We need to ride that out. But if you're in another market right now, like oil and gas, for numerous macroeconomic and political reasons, the cash flow is great. Valuations are going up, and it's a really exciting place. And it's that lower risk portfolio, not by chasing the lowest risk deals, but by chasing a lower risk, diversified position of your capital across different investments. And so I like to tell people, to really succeed, you need to be diversified. And so that's what we help people do on Invest on Main Street. That was the purpose of that.
Well, thanks so much for sharing that. This is a perfect segue to the diversification topic. Let's talk about oil and gas. You mentioned a few times, and pretend I know nothing about the industry. Could you talk about what is oil and gas investing and why someone should even consider it?
So back in the day when people didn't just own Teslas, we used something called gasoline. Actually, it takes 800 barrels of oil, crude oil, to make a Tesla. And I think it's kind of funny because I get that a lot. In fact, 38% of the electricity in the United States is the burning of natural gas. So this proliferation of electric vehicles stressing the power grid is driving the need for burning of fossil fuels. And certainly we would love for green and sustainable energies to take a hold. And they are incrementally as technologies develop. And that's great. But the reality is in the next 3 to 5 years, somebody's going to be drilling for oil and natural gas. And the Western supply has been strained by Russia misbehaving, Europe pulling out. OPEC controls this right now. Elon Musk even said we need to increase domestic production of natural gas and oil. Robert Kiyosaki, Rich Dad Poor Dad, this year saying he's investing North Dakota and Texas natural gas and oil. Warren Buffett just put $12 billion in American natural gas and oil. It's important to invest in some of these things that are essential needs. It's not dissimilar from real estate in the business model. In real estate, we may buy an apartment building, right? We may buy it distressed or where it needs to add value, improve it, and we may renovate the units, right? As we renovate units, we get greater cash flow, and then we have a greater value of the building. Well, in oil and gas and our diversified funds, which are unique from every other oil and gas deal that I've seen out there, it's a completely different approach. We buy a lease, right? And in the lease, we have proven reserves. We don't wildcat or explore. Proven reserves in these leases, just like we have a proven ability to collect income from multifamily. And we have something called PUDs, which are proven undeveloped drilling sites. And so we buy the lease and adjacent or nearby all these producing wells. So just like a building, it's nearby all these comparables. And we begin drilling on these wells. And as we drill these wells and we harvest these hydrocarbons, we then cash flow more. And as the lease begins to appreciate through the greater cash flow and the greater reserves that are discovered, you then have a higher value for the lease. Not only cash flowing, but a real asset that is growing in value that allows you to exit. Just like in a multifamily deal, we use a PUD multiple. Multifamily uses a cap rate. It's a similar kind of value add strategy. You get in, you monthly passive cash flow, you get your capital back, and you exit. It's just one is the housing need and one is the energy need. And we diversify them. It's a little higher risk in oil and gas, that's true, but we do that through scale, put you in dozens of wells, like in multifamily, put you in hundreds of units. If one unit floods or has a fire, you're okay, right? Because it washes out the economics. Well, It's very common that a well won't produce, or your drill bit gets stuck a mile down or a mile across, or something. But through scale, we can we can limit that operational risk, right? And provide similar risk-adjusted returns than many real estate deals, but better tax advantages because your investment like comes off your adjusted gross income, comes off your ordinary income. So it's very attractive for the high income earners out there.
Okay, that's really interesting. You kept mentioning lease, and is this like what is a lease? Is it the same context as, oh, I'm leasing an apartment, or is this completely different?
Yeah, so a lease is not the landowner. A lease means you now have control over the reserves below. You have the ability to drill in this acreage, right, where there's known proven reserves below. And now we have the ability to drill, and then we have the ability to harvest those hydrocarbons or that natural gas or oil.
Got it.
And
So you
so
basically
the
have the right to drill, and you pay
Mhm.
for the right to drill.
Yeah, so you buy the lease, right, and then now you can drill and harvest those the hydrocarbons that are down below. And so when you buy a lease, it comes with things like, okay, this lease is this land, it's this area, and on this lease and nearby this lease or included in this lease are these producing wells. Also, geologists have said that based on these producing wells and the contour below the earth, they've done 3D seismic and they've said, well, here's the total reserves. There's 400 million in reserves under this. And based on the contour of the earth, here's the next dozen places you can drill. We call those proven undeveloped sites. Just like if we had a land that we bought and there's a dozen pads that we could build on, right? With nearby comparables that are already built and producing. We have that same thing. So we don't wildcat in the middle of nowhere where there's no discovery, where we're completely gambling. In fact, we pay higher prices to leases and pay royalties. So we buy much more known quantity and we farm it essentially, rather than just kind of get Jed Clampett rich by shooting a hole in the ground with whatever he did, a gun or something. It's insane. But it's true. There's a lot. It has a bad reputation because a lot of people are gambling huge, and that's not what I do. I mean, I'm an old
Yeah.
school multifamily guy that lost everything. I want to do very reasonable returns and very low risk profile. But I know I can't do it all in one vertical. Real estate people are like, oh, I'm in multifamily, I'm in assisted living, I'm in commercial, I'm in retail, I'm mobile home park, I'm diversified. No, you're not. That is all one vertical. And that is riding a correction right now together, right? Diversification is a non-correlated asset. Assets is so different,
Yeah.
different metrics, right? And that's the journey that I think the financial IQ of America really has not ventured into. And it's just like in real estate, multifamily, mostly financial institutions are there, but you can be too through syndications, just like we are in multifamily. So that's the journey that I'm trying to help make accessible.
Yeah. So a question that I get from that, again, coming from someone who knows nothing about this industry, is at what point do you know it's time to exit from oil and gas, right? With real estate or stock market, there are signs, but again, I know nothing about this industry. So at what point do you think you would want to exit from oil and gas?
Well, so we exit when we run out of money. So, because yeah, so just like in a multifamily deal, you're going to raise money to buy the property. You're going to raise capital expenditures to improve the property, and you're going to see as you renovate all the units, you're going to see what rents you can get up to, and then you're going to then enforce the value through renovations as best you can with the budget you have, right? And then you've got to either decide raise more and then do something else, or now we pretty much got it to market. We pretty much got the value from distressed below here under producing. We pretty much got it to where it is. How about we 1031 exchange this to the next deal where we can buy another thing that we can add value to and go to work and improve, right? So in oil and gas is somewhat similar. We're going to buy a lease with all these sites that are yet to be developed. We're going to spend our $200 million buying leases in multiple states. We're going to drill dozens of wells across multiple states with geographic diversification. We're going to drill some for oil and some for gas to give us product diversification. Then eventually we're going to run out of the drill plan, which is 20 wells or so. And we say, you know what? We did it. We accomplished the goal, which was drill all these wells. We produced this cash flow. We've created the value. Let's sell this off and offer an option to our investors to 1031 exchange on off to the next investment where we can continue to drive more value. And so that's a 3 to 5 year plan.
Got it. That makes a lot of sense. So for this current deal that you're working on, or the most recent deal, Could you talk a little bit more about the financials? You don't need to give the exact numbers, but kind of how much are you typically raising and how much does an average deal, how does it work?
It's similar to a multifamily deal, but if you were to do lots of multifamilies across multiple states, because oil and gas drilling, in order to do it safely, you have to do it at scale. You can't just do one well. The one well thing is why it has a bad reputation, because people will lose it all sometimes. Like in a multifamily, to get 100 units, we do dozens of wells. So we're raising $200 million in this fund, right, with my partners. And they're operating in 5 locations called basins. Real estate, we call them markets. And in real estate, we have landlord-friendly markets, right? And we have drill-friendly and permit-friendly basins in oil and gas. And so we have basins in oil and gas. And the way it works is we raise the capital, and then and in parallel with raising the capital, we'll purchase the leases, and then we will then begin drilling. And it typically is about a 3 to 4 month process before we start cash flowing. And then just like in a real estate deal, you would start monthly passive income from the sale of natural gas and oil for each of the wells that you begin to build. And they're complex. They're down a mile, and then they're horizontal a mile or 2 miles. We're horizontally fracking for a whole mile or two. It takes a while to fully get these wells to flow at their maximum value. So that's happening across multiple states, and some half oil and half gas. And so that the cash flow is a little bumpy. It's a bumpy ride, not like the steady growth in a multifamily deal. But you're developing your asset and you're increasing your reserve valuation. Then in a year 3, we have what we're projecting to be a return of capital. Kind of similar to doing a refinance in multifamily, where you're de-risked by getting your capital back through a refinance. But we're not planning to do any debt. So we're protected from the downside of debt. And if the market falls, we can ride it out because we don't have a debt payment. But we're going to sell off a piece of it, right, to do that sort of de-risk your investment. And that's usually year 2 to 3. But then we continue to drill and cash flow. And when you sell off, the cash flow goes down a little bit, but then you got more wells that bring it back up a little bit. And then in years 3 to 5, we begin selling off large pieces of it to different operators in the areas, just like if you sold a multi-state real estate portfolio, you kind of piece it out to the people that are local that'll pay the highest. Some of the parts is better than the whole, just like in real estate if you're a multi-state type investment. So it typically works out somewhere in 10 to 20% average annual cash flow over the hold period. And oftentimes we project a 3x equity multiple. It's a little bit higher risk profile, but we help to manage that through diversification. But the returns are also higher, especially now. And when you're seeing a correction in real estate, this is a good way to cash flow on an appreciating, growing market. And so that's how those typically pan out.
That's incredible. Raising $200 million. That sounds absolutely insane in a good way. So congratulations on all that, Patrick.
Well, the key is partnering, like we were talking before, right? You got to work with people that have decades track record, and
That's incredible. And I want to shift the conversation a little bit. You wrote a book, and I want to hear more about it, and maybe even talk about it for the audience and what it's about.
Well, I started out by telling my sob story, so they got a little intro on. So eventually I was being the engineer. I kept my head really close to the grinding wheel for many years, and I didn't get my story out there. And so when I started getting a couple $100 million in the multifamily portfolio, some friends said, hey, you need to get your story out there. You need to get more out in front of people. And so I helped write a book. I did a chapter in this called Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities. I'm on here, and I still had hair. The hair fell out during COVID. My wife cut it off. But yeah, it was this really cool people. Phil Collins, the guitarist of Def Leppard, is on here. NFL, NBA players, Russell Gray from the Real Estate Guys. Brian Tracy did the foreword. I had such a great time learning the story from a bunch of really cool people. And I have a chapter that I tell my whole story. I'm happy to give it away for free to your listeners, as long as they type a promo code investonmainstreet.com/book. Investonmainstreet.com/book. And then what promo codes should they use?
They could use VK Podcast, as in VJ Kailash Podcast.
Okay, so we'll make sure, and then I sign them, and we ship a free copy out. I believe in the stories. It's a lot of really cool stories from some great people. happy to share that with you.
Awesome. I'll definitely put them in the show notes. And Patrick, I want to hear, outside of the book that you wrote, what is your favorite book that you think can benefit the audience?
Well, so the Purple Book, Robert Kiyosaki's, is the one that really beefed up and transformed my Rich Dad Poor Dad. Obviously, not to be too cliche, that's it. Traction, I'd say, or The One Thing. I think the One Thing by Gary Keller has probably made the biggest difference in the growth of my business, because as you can imagine, there's so many pieces of noise coming at you. If you listen to all of them, it just can be impossible, debilitating to actually progress. And time blocking and paying attention to those things that will move the company forward it was really, the tools are basic, but profound. And it made a big difference for me.
Definitely. Yeah, I read all three of those. So I would mirror that. So everyone that's listening to this, grab yourself a copy of all three of those books. They will definitely change your life. And
sorry, I couldn't list just one. There's so many.
No. I'm with you. I have. Yeah. Well, that sounds great. Patrick, and the last question I have for you is, where can our audience get in touch with you? This has been a great conversation.
Investonmainandthenstreet.com is our website. Investonmainandthenstreet.com. You'll see our investments open at the top. If you go to contact, investonmainstreet.com/contact, you can set a meeting up on my calendar. Happy to chat with anybody. There's pretty low pressure. Part of what I love to do is build relationships. And if my investments aren't a good fit for you, that's okay. I can get you pointed off in other directions. So feel free to do that. And my email is patrick@investonmainandthenstreet.com.
Perfect. I'll put all this in the show notes. Patrick, thank you so much for your time. It's been great.
Absolutely. I appreciate it. Thanks so much.